What's up, everybody? Welcome back to my channel. Hope you guys are having an amazing day. If it's your first time here, welcome. It is great to have you. I am currently reading a book and going over each chapter with you guys as I finish the chapter and giving you a little bit of what I got from each chapter. So the book I'm reading is called What Would the Rockefellers Do? How the Wealthy Get and Stay That Way, and How You Can Too, by Garrett B. Gunderson. This book talks about cash flow insurance. That's life insurance, and it is a policy that not only has a death benefit. So if you pass away, your loved ones get a certain amount of money, 300,000, 500,000, but it also builds cash value. Now, the two most popular ones are indexed universal life policies. These policies, the money you put into it every month, or the money you put into it in general, gets invested, and it's not a fixed rate. It's usually based on the stock markets, but it's not volatile, right? So it doesn't fall as bad as like the stock market is falling. So it is invested very wisely. The other one is a straight whole life policy. All whole life policies do build cash value. Typically, whole life policies are a fixed rate. So whatever the company is offering, whether it's 5%, 6%, usually a lot more than a bank will offer you. It's usually about 5 or 6% from what I've seen that your money gets invested each time, not invested, but grows each time, each month you put the money into it. So you're not only getting a death benefit for your family, but you're also going to be able to build some cash value throughout the life of the policy. Both policies are permanent and whole life policies. We're on chapter 5, and it's called Finding Money to Fund Your Bank. All right, this is the most important thing, right? Because in order to invest or in order to get a policy like this, you have to have some money to put into it so it grows, right? So the first thing I'm going to go over from the book is just a few different points he makes in regards to the type of expenses. This is very important, right? Because the very first one is destructive expenses. These are just vices. These are the things that you don't need to spend money on, like cigarettes and beer and gambling and drugs and all the stuff that you don't need in your life, and you're just throwing your money away. It has no benefit to you whatsoever. It's just not a very, very good way to spend your money, right? We can agree with that. That if you have any of these kind of vices, these things, it's important that you, if you want to take out one of these policies, it's important to understand that and do your best to get away from those. Consumptive or lifestyle expenses, such as vacations and buying a flat screen TV, and to build memories. These are important, but just be wary on how you spend your money on these. A lot of people, like, they make their money for the first 3 or 4 months at work, and they spend all of it to go on vacation. They do the same thing, spend all of it to go on vacation. Like, do it in moderation. It's important to have memories and take vacations and buy things when you need them, right? It's also important to understand when you need them, and the importance of saving some of that money, putting some of that money away for the future, because we are working and living our lives realistically for our futures, for our retirement, to have a good life in the future. Not saying not to buy stuff, not saying not to go on vacations, because they're important, but just be wary on how often you do it, right? Once, twice a year, really all you really need, in my opinion. The third one is protective expenses. They're used to protect your property and human life values, including your mindset and happiness. So for these, basically disability insurance, medical insurance, car insurance, life insurance. These are things that are important that you need to protect your stuff, right? Protect your life, protect everything around you. That stuff you should be spending money on. You should have health insurance. You should have life insurance. Obviously, in these videos, I'm talking about cash flow insurance, right? So life insurance, if you have a policy, do your best for it to be one of these, either whole life or index universal life policy. But protective expenses are those expenses that are needed to protect something, right? The last one was productive expenses. So these are expenses that allow you to expand your cash flow, grow your business, and build assets, right? These are productive. This is where you put money into something and it grows, right? It doesn't just sit there. Your bank is an example of that. It doesn't give you a lot of interest, but life insurance policies, which we're talking about obviously right now, cash flow insurance policies, and other things that will help your money grow, and that is productive expenses, right? So essentially, how to fund your cash flow insurance. It's important to understand how you're spending your money, right? Where is your money going? At the end of the month, look at it. What are you spending money on? Are there things you can get rid of? Subscriptions that you're paying for? Whether you're buying shoes every 2 weeks or $300 sneakers every other month, right? Where are you spending your money, and where can you tighten up? And you can have a little bit of extra money to put towards a policy like this. $100 a month, $150 a month. It doesn't need to be $400, $500. If you can afford that, that's obviously the recommendation is to overfund these types of policies, whole life or index universal life policies. But you got to start somewhere. If you can clear up some money, put in 100, 150, right? Get a policy where that's the amount, right? And build and build and build until you're able to put more money into it. But maybe you get your tax refund back and you get a good amount. Put 500 in there every year, right? And it will grow exponentially, right? It will grow throughout the years. And remember, we talked about in one of the last videos, this is a policy you can borrow money from. It is your own personal bank, for lack of a better term. So 10 years down the line, if you have $100,000 left on your mortgage and you have $30,000 in your cash flow insurance, and you want to take some of that out and put it towards the house to bring that money down, to bring down that mortgage, you can do that. It is your money. No one's going to tell you no. It's not taxed. And you can just take the money and use it and pay the loan back how you want to pay it back. We always recommend that you do pay it back. But the money is there for you. Children's college, medical bills, etc. Whatever you need money for in the future, it is there for you to take. But to fund it, like I said, you have to figure out where your money is going. How can you create a little extra room in your budget where you can put the money towards your future, towards this type of policy, and you can grow that, and it can be super, super helpful in the future. So realistically, this chapter is just don't do destructive spending. Find ways to cut down on what you're spending your money on and put it towards something meaningful, very important for your future. A policy like this, I highly recommend it. Like I said, I have one. Probably going to get another one because you just have to have the money, the liquidity, and of course, you are protecting your family's future in the event of your passing. So it's a dual policy, and it's super amazing. So, all right, that's chapter 5. I got that right this time. That was chapter 5. And I'll be going over chapter 6 in a bit. So hope you enjoyed this. If you have any questions, feel free to comment below. And again, thanks for watching. Have a great rest of your day. Take care.